Good morning. Welcome to the morning market briefing. Today is Tuesday, February 10th, 2026. We've got a lot to get to today. This is one of the most interesting days this entire earnings season, Tom, because we're actually getting companies that a lot of people see around all over the place that they interact with. They may not even know it, but they're giving us a little bit more information about what's going on in the economy. I've put together a few big highlights here, and we'll start off there, and then we'll also talk a little bit about kind of the subpoena that's going on with the health insurers right now. And then I also want to spend some time talking about interest rates and bonds. We did get a headline earlier this morning from Bank of America CEO Brian Moynihan saying that interest rates are going lower, and he said that almost as a statement of fact. So I think that that's something that we should pay attention to. But first, let's start off with what we're seeing across the United States. This is focused on the United States here today specifically, and talk a little bit about what we're seeing from companies all over. So first of all, the NFIB Small Business Optimism came out this morning, came out at 6 a.m. This is a survey that's done for the month of January. And so in January, there are a lot of things moving back and forth, including the threat of tariffs against the EU, the Greenland issues, as well as the tariff issues with Canada and South Korea. So we did see uncertainty tick up. I think the big takeaway, though, is that small businesses remain jittery and unsure despite the strong GDP headlines. The head of the NFIB survey, Bill Dunkelberg, said, quote, and I think this is very apropos, he says, while GDP is rising, small businesses are still waiting for noticeable economic growth. Focusing on GDP, the economy is flying. A 4.2% gain in the latest release suggests we're in the middle of a boom, but meanwhile, small business owners aren't feeling the pain, feeling the gain, or at least not at that level of economic growth. And I think the reason for this, Tom, as we've talked about, is mostly the data centers. And if you look at CapEx spending expectations from a lot of these small businesses, they're really no higher than they've ever been. In fact, they're arguably falling. And so I think that as we look for broadening out of the economy to persist into the second half of the year, we're going to need to see some improvement in this type of data.
Yeah, this is a total tangent, but just something I've been thinking about with the growth thing, which is that for a long time we've been propping up growth at the GDP level by deficit spending. We spent more money than we've taken in. We've printed money. We pushed money into the system. The effective double whammy of that money being reduced at the government level, brought in from the tariff level, and then the third leg of this stool that I'm sitting on is the enormous amount of CapEx that's coming out of the world's largest companies could actually push GDP growth extremely high. Because you basically got the government's not wasting, which brings down demand for everything else. Everyone else can now buy things to create. Who's going to do that? Well, these huge companies are spending $1 trillion to do it. And then, you're basically setting up for, huge expansion, because the third piece is the tariff money. All of the investment that's been promised is now coming. We're breaking ground on those things. And instead of the government building stuff to make the economy go, call it the FDR model, we're now having the government facilitating the ability for private companies to create growth. So that's the three-legged stool. This is not Besant's three-legged stool. This is my three-legged stool, which could actually be really beneficial for the economy. And as a result, I think that the level of demand to invest is going to bring rates down, because there's just going to be competition for who's going to be able to lend that money to those people to build the data centers, to build the factories, to build, whatever it is. You want to plant a new field of corn, go sick, because it doesn't make sense to do it by importing that corn anymore, because we can make it better here now, cheaper, because the tariffs are in place. I don't know. That's a completely half-baked thought, but that's something I've been rolling over my head for the last, call it, 24 hours.
We'll circle back on that GDP comment, because there will be something announced by Trump today in his interview with Larry Kudlow that'll air at 4 p.m. on Fox Business, and he's talking about pretty significant GDP growth. So I want to peel that onion back a little bit further, Tom. But for now, kind of sticking with the here and now, we did get Costco and Hicks. I can see that the image isn't working because I did not use a background color. Instead of, I just used white, so the white's not showing up. But what we did see, and this was about a week ago, is that the basket size was really improving at Costco, which means that people were putting more stuff in their basket. They were going to Costco and buying more than just the need to haves and buying some of the nice to haves, which is something that we haven't really seen. And this is a trend that's persisted for some time now. I'm talking like the last 3 to 5 months. And so I was looking at that data, and obviously the thing that you first jump to in this heightened inflationary aware environment is, well, it's got to be pricing. It's not, if the transaction value is going up, the average transaction at Costco is going up, it's got to be because prices are going up. But I looked back at the commentary for the last 3 quarters. They said it's all inflation is about where it's been. I do think if we had such a meaningful acceleration, I'm talking to the tune of 2 to 3 percentage points month over month, that would show up in the true inflation data, and it's going the other way. And even beyond that, I think we'd see headlines about it. And so the only logical conclusion for me is that people are putting more stuff in the basket. And that's actually backed up by the fact that we just accelerated the non-foods category of what they have, and from mid-single digits to low double digits. So think like going from 5% to 10 to 11 percentage points of year-over-year growth. And again, people might say, well, the winter storms, but the winter storms should have such an effect on foods as well. And it did not. But what it did have an effect on was those non-foods. And so we're seeing an acceleration in discretionary spending, which is something that we've also seen in other companies. And then Taiwan Semiconductor just this morning reported accelerating monthly sales, which is basically the best level of growth since the summer. January had sales up 37%. The last 3 months have averaged right around 20%. So people are consuming more. People are buying more chips, and not just Frito-Lay. In fact, they're actually not buying many more Frito-Lay, but they're buying more discretionary products, and they're buying and companies are investing more in chips. And then even on the industrial side, Fastenal daily sales accelerated from 10.7 to 12% month over month. And again, that includes the winter storms, with particular strength in non-residential construction. Non-residential construction went from 10.8 to 16.2. It hadn't been above 11.5 for the last 6 months. So, and maybe beyond that, I only went back 6 months. My point being is that January was good. Despite the storms, January was good, and momentum is building. And I would expect if we did this survey today on the NFIB Small Business Optimism, it would be better than the survey data that we got this morning. And the reason is when they were doing the survey in January, things were much worse.
I mean, we got some other data that I think even adds a little bit more fuel to that fire, which is we got import price index. Month over month, imports up 0.1%. And you wouldn't believe it, but year over year, so going all the way back to right before Liberation Day, import price index up 0.0%.
Was that in line with estimates, or?
It's below estimates.
Below estimates.
Yeah, so the month over month was in line. The year over year was expected to be 0.1. It was 0. Notably, though, export price index year over year, 3.1% increase, which is above expectation of 3%. So we're selling things overseas for higher prices at a much higher rate than we're bringing in things for higher prices. So the tariff inflation is the dog that didn't bark. Continues to not bark.
Indeed. And I think people complaining about the weak dollar, but the weak dollar just perpetuates that. It allows us to export and charge more for what we have because it's still cheaper in euros or yen or any of these other currencies. So that's where currency actually does help us to an extent. Continuing on, I basically think that the economy is accelerating in January, and I think some of these survey measures that we've been getting are a little bit phony. I do think that it's worth spending a little bit of time on pricing. I mentioned Costco earlier, but Coca-Cola, they had 6 percentage points of pricing last quarter in North America. That fell to 4% in the most recent quarter, and their guidance implies that it's going to fall further this year. They've only guided to 4 to 5% total revenue growth. And they've previously made an effort to say we're getting back to volume growth. So you do the math on that, and it's like, well, pricing has to be less than 3%. So we're seeing continued price disinflation at Coca-Cola. We're seeing price disinflation or deflation even at Pepsi, at General Mills. And I just put all this together, and I think Brian Moynihan hit the nail on the head. I think inflation's going low, and I think interest rates are going low. And I think this could be a huge week for bonds, Tom, as I think about the employment number that we get tomorrow, the import-export prices that we already got today, and most importantly, the CPI number that we get on Friday. The estimate that is that the CPI number will print the lowest core reading going back to to March 2021. And it'll be pretty clearly on a downward trajectory. We had a downward trajectory, and there was a little bit of a bubble in the summer of last year as the tariffs got passed through. And then that downward trajectory has resumed. Oh, and by the way, in April and May, we're going to comp over that bubble. And I think that we'll even accelerate to the downside further. I got to be careful how I say this, because this is not my base case. I want to be very clear. This is not my base case. But
Option B, what's the probabilistic outcome of this particular non-base case scenario, Ben?
More than 10%, probably less than 25%.
And base case would be 50 or more?
Yeah.
Okay.
There's a chance that we're at 2% inflation by the time Kevin Warsh takes office as Fed chair.
If we're not already there now, a lot of people are saying.
And there's also a chance that in that scenario, unemployment is 4.8, 4.9, even 5.
Assuming it's not already 5% right now, because the jobs data is so trustworthy.
And I think the data that we get this week will help really put a little bit more meat on that bone. If that case is going to be right, we'll de-risk it significantly this week.
Yeah,
which I think spells a really, really interesting market for bonds.
I mean, I would say, and we talked about this a little bit yesterday afternoon, right before I walked out the door, but I think that inflation already is at 2 and unemployment is already at 5. I just think that the data is extremely poorly managed and poorly measured as well. So I think that's where we are. I mean, I think that realistically we should be at a 3 on the federal funds rate. I don't think much lower than that. I don't think we need to be cutting to 0, but I don't think it's helping anyone that we're at 3.5. But the long end, I continue to hammer, is still ridiculously cheap. We're very steep on the 10s, 30s. And it's moving down today. Yesterday we opened at basically a 424 on the 10-year. We're at a 417, which in recent history is a pretty big one-day move. We haven't seen a lot of volatility, but that's a big move downward in rates. And as recently as last week, we were able to buy some 30-year treasuries over 5%. The 30-year is now at a 481. So, I mean, that's probably, 15 basis points at least a move. I mean, we're buying some of the more out-of-favor, lower coupon stuff just to add pure duration, but pure duration is what gets the biggest upside when you have a fall from 495 to 481. And so that's why we were targeting those bonds specifically. But I think right now it's still an opportunity to just add duration. Right now, the indexes, at least in bond world, have the ag is roughly flat, but the muni index has done very well because people are just loading into short bonds. That trade is gone. Those aren't cheap. They're not interesting. You're not making any yield there. Right now, long munis are very, very cheap relative to short munis, especially when you start factoring in the tax equivalency. And so we've been hammering those as well. You know, when the air comes out of that balloon, it's gonna go quickly, I think. But I don't know. I think I've been at the 2% inflation, 5% unemployment for a while now. I don't think that we're far off from the rest of the financial media to catch on to that. And I think that when it does, we're going to see rates come down pretty quick.
I'm more an equity guy. I'm relatively young. I want to position for the long term. The 30-year bond is now 10% of my overall investments in my personal account, and I'm thinking of increasing that by another 50% to 15%. Because I think you have the asymmetry, first of all, from the convexity of the 30-year, but then you also have the asymmetry in the data. I think that there is a chance this week that we come in at 2.6%, a little bit hot on inflation, and unemployment still pretty low at 4.4, even 4.3. In which case, maybe we go to 4.3% on the 10-year. But I don't think that we're going to 4.7 or 4.8 or 5 on the 10-year bond. And I think that there's actually a chance that we can go significantly lower. And so I think there's an asymmetry on the data coming out, and I think there's an asymmetry just from the structure of bonds themselves.
Yeah. And I mean, it remains to be seen. We could get some data that could skew that the opposite way really quickly. But the difference is, again, it's probabilistic outcomes. What is the probability that we go over a 5 on the 30-year? Maybe 30%. But what's the probability that we go to 6% and you just get to take a bath on those? I would put it at less than 1. So you're basically looking at, hey, worst case scenario, we might be down 1% in the short term, but we're still going to amortize off another 5 in a single year. So you're up 4 on a 12-month basis, which is a nice return for bonds historically. And then the odds that we're going to come down from there are significantly higher. And, so what are your odds that you could have a double-digit return this year plus your income? I think it's very high. I mean, you could see a 1% move on the 30-year downward would functionally be, call it 16% return in 1 year on a bond. You could sell that, you could move around, you could find other stuff, or you could just hold it and you could clip that 5% until I will be deceased, And so that's, you have so many, the probabilistic outcomes we talked about. What are the, how can you chunk it up? What's going to happen? The bad scenarios have been squished down to the very small piece, and the good scenarios are almost endless going the other direction. And so you want to position yourself where you just, the bad scenarios are very unlikely. Good scenarios are very likely, even if the gradient of how good it could be is different,
Let's just live in this world, and this will be a segue to the next topic, and I don't want to belabor this too much, but just quick thought on if inflation is 2.1 or 2.2 or even 2 when Kevin Warsh takes the helm, and it's probably on a modest downward trajectory. What is Warsh's base case? Is his base case to, if we're at target, you might as well juice this thing and just continue to ease until we start to see inflation picking up? Or is his base case, we made it to target, let's just stay where we are? Do you have a read on that?
I would think that his base case would be, honestly, I think they harp on the unemployment, even though I don't think that rate cuts are going to help that because of the way the market has moved structurally. I think that there's a possibility you could get a 50 basis point cut and then nothing for the rest of the year.
Yep.
That's kind of my, my non-base case, but I think it come in and be like, hey, unemployment's rising quickly. Inflation's not there anymore. We're at target. Let's ease 50 basis points. And then there's some part of me that thinks that Kevin Warsh is smart enough to know that not everyone is employable, but there's also part of me that worries that the headlines are going to be, I've got to take care of this unemployment thing. How am I going to do it? I'm going to start cutting rates. And then I think we get into trouble where we just would get back into zero interest rate policy or too low interest rates. And then you start to see stuff get wonky again. I worry that they'll attack it too hard.
On the other side, Tom, he's going to be really pushed by the president. Trump says in this interview with Kudlow today, that'll be aired today, he says Warsh can get to 15% GDP growth, quote, if he does the job that we're capable of. I mean, I think it's just worth noting what 15% growth implies. And you talked about this earlier in terms of productivity and all of this. But without labor growth, the only other way that we can get GDP growth significantly higher is productivity. So that means that you and your job, Hicks and his job, me and my job, and every person who's working across the United States has to become 15% more productive, not over 3 or 4 years, but this year. And then they've got to do it again. That's hugely, hugely significant ambition. And I don't know if America's got what it takes. And that's kind of sad, but it's also, 15% increased productivity is substantial.
I mean, I don't think it's outside the realm of possibility if I mean, think about how many people work for the government. Think about all of this fraud that's been uncovered where we're just sending checks out into the abyss. If that came to an end and say that there's, even on the low end, they say there's $500 billion in money that's just evaporates into the ether every year. You take that to zero, that is a huge wet blanket that's taken off. That's money that comes out of your pocket and my pocket and Hicks's pocket and everyone listening to this pocket, and they just throw it in the toilet and they flush it and they go, great job. I mean, that right there, I mean, think about how much more efficient the government would be.
I mean, so if you're thinking through that lens, I just gave you the like for like.
Yeah.
So I said, you in your role, me in my role, Hicks in his role, every government employee in their roles. But what happens if we try to high grade those roles and government employees are no longer government employees? They're working at Palantir.
Yeah. Or they're looking to have a return on invested capital of your tax dollars.
Yep.
What is the ROIC of my tax dollars? I would argue it's probably negative, especially if a half of the annual deficit could be accounted for by just the fraud that they're starting to uncover everywhere. I mean, that's huge. We could cut the deficit in half by just saying, hey, we're not giving money to people who we don't know who they are, and they don't return any value from that money. Do you have to, I mean, it's like there used to be a lot of pushback. I think it was Newt Gingrich who put, like, if you're going to be on welfare, you've got to work 20 hours a week, whether it be volunteering, you've got to do something. Even if you're not generating money for yourself, we're going to give you a check and you can go volunteer at a hospital or a nursing home. And that would facilitate that you're doing something. There's a return on that. I mean, think about that with all of these blank checks. It's like you get a stimulus check, but you've got to go do something, anything. You've got to show you did 20 hours of community service up at Must Ministries, the homeless shelter down the street from us. Think about how much productivity would be enhanced by that, how many lives would be impacted by that. But instead of just being like, we're going to cut a check to these 14 businesses registered to this one address in Minnesota where no one seems to be there and the lights are off and it's just a mailbox, like that productivity is negative. Those dollars evaporate. They're gone. How do we take $1 and turn it into $1.10? Even taking $1 and taking it from being a complete loss to a 50% loss. Think about the difference between getting a 0 on your homework and getting a 50 on your homework. That's the difference between getting an F and a C, because maybe you did well on the tests, I mean, it's all about averages. And so I think that's something that's really lost in this whole scenario where people are fighting so hard against this. It's like, everybody hates paying taxes. Even these communist weirdos hate paying taxes because that's money out of their pocket. They want to be getting money sent back to them from your pocket, but the problem is we're sending it to somebody else. But think about how much money from your pocket they could get if we weren't just burning it up. They could get so much of your money, Ben. Billions of dollars. So I think it's just, like when people just don't think about it rationally. I think that much of the conflict in my life comes from that I can't help but think about these things this way, and it feels mean to people. I feel like people think I'm being mean about it, but it's like, God, man, it's like we're like these big numbers that Meta's, Amazon's gonna spend $200 billion on CapEx this year, and everyone's absolutely screaming and everything's on fire. We're spending 2.5 times that on nothing. They're worried they're not going to get a return on investment on their data centers. Guess what your return on investment was? 0. Absolutely 0. Your return on investment is people screaming in the streets of the people who are trying to prevent this from happening. So that is the end of my rant. But it's crazy. It's absolutely insane in my opinion. And maybe it sounds cold and callous, but they sit down. I would say that a lot of people, when you're feeling emotional, you're feeling like you saw something on TV and it makes you just so angry, consider this. Am I thinking about this rationally, or am I just being led around by, anxieties about things that will never occur? That's all I have to say about that. But it's true. I mean, it's, you have to think about it. I mean, investing in markets, you have to think rationally. Market's down. Is that good or bad? Well, it depends,
Happiness guest speaker who spoke at our macro event. Tom Harmon. Sorry. Tom Harmon talked about this, and he said that 90% of anxieties do not occur. So don't waste time worrying about it. So, to your point, let's be rational. Let's not worry. Yeah. Things are okay.
Chill out, man. Just think about it. You know.
We'll see you tomorrow. Bye.